Stay tuned to hear our take on the airline industry and airline stocks, as well as where we think gold and real estate will go over the next few years. Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, March 25th, 2024 edition. I'm Justin Klein, and back with me is Luke to celebrate our first entrance into the Sweet 16 of the InvestTalk Market Madness. We had a few underdogs, I think, take it today, and we are going to highlight the matchups for tomorrow. But Luke, what are you excited about these matchups?
Oh, I'm even more excited as more and more names get eliminated, looking into someday, pretty soon, getting to the championship.
Yeah, it's gonna line up with the matchup of the NCAA tournament, which is the final day will be on April 8th. April 8th, I believe, is the championship matchup, both for the InvestTalk Market Madness and the NCAA tournament. So we have a couple more weeks plus a day left, and to ensure you're in the loop, just make sure you download each podcast and get our in-depth analysis and our predictions of who's going to win the next matchups. And we're going to highlight the matchups for tomorrow. But today there were some winners, and they were VRT, which is Vertiv Holdings. We also had Blend Labs, Cytokinetics, and Fiber, which is that is the name of that again? Frontier. There we go. Frontier Communication. So all four will be moving on to the Sweet 16 of the new economy region in the InvestTalk Market Madness, and we're going to get to the old economy region here in a little bit and preview tomorrow's matchups. But before we get into the heart of today's show and talk about the market performance and run down the show topics, we're going to answer our first caller question now.
Hi, I'm Kay calling from New York. Just want to ask about your take on the JETS. I'm about 29, looking to hold this for the next couple of decades, and just want your look. Thank you.
Oh, see, this is the tough one because JETS, this is an ETF, the U.S. Global JETS ETF. And this is a lesson, one of the first lessons I ever learned from my grandfather was don't invest in airlines. They're just bad businesses in general. They're highly competitive, highly capital intensive. You have to deal with unions, for the pilots unions and the flight attendant unions, etc. And it's a cyclical business. It's just not a great business to be in. And that's why I think this stock has generally been in a downtrend because you're getting exposure to mainly the airlines here. The top holding is Delta, United, American Airlines, Southwest, Alaska, Air Canada, JetBlue, etc. So I definitely wouldn't own this for multiple decades, like the caller said. What are your take on airlines? I could just be biased because that was one of the first lessons I learned.
No, I think that's fair. I think they're incredibly highly capital intensive to run an airline. It's a tough business to start up in. There's high regulatory scrutiny because they may be the safest form of transportation, but when something goes wrong, they're also incredibly visible. People pay attention to them. And like you said, they're cyclical, right? They still haven't reached they're still down. This ETF is still down, it looks like 28, 29%, nearly 30% from 5 years ago. Still hasn't reached its pre-pandemic high. So it's a tough business to get into. And if you're going to hold it through multiple cycles, maybe you get a positive investment return, but we're talking about the scarcest resource to each people besides time, which is their capital. And is this really where you want to put it?
And if you go all the way back to when this ETF launched, it was at around $24 per share. Now we're at $20.37. That was back in 2015. So we're going on nearly a decade, and this thing is still down, right? So, and then you add on top of that, well, I guess the best argument, if I were to strongman this argument, it would be that the airlines have certainly changed their business to make their airline miles worth, that business is worth a lot. In many instances, more than actually the airline business. And so, a lot of them have kind of cracked that code to make themselves more profitable. But I would rather just invest in the ones that have done that to the better than most. But in general, it's like you said, capital is scarce. Your capital is scarce. Why would you want to put it into a sector that just generally has poor long-term risk-adjusted returns? Airlines are near the bottom of that list. So I would stay far away. Let's go to James in New York. He wants to talk about gold. GOLD, are you talking about Barrick or actual investing in gold?
No, in particular, well, both, but particularly Barrick Gold in this case. I've been dollar cost averaging into that company for a little while now, almost at a full position, and I'm just wondering. It seems as increasing gold prices as they go up, it seems like a name like Barrick, for example, is underperforming during a time like that. Is it even worth holding anymore? I was hoping to hold it for another year, maybe two.
Well, Barrick is one of the largest miners out there, $27 billion market cap. And, they're one of the world's largest. They have nearly 4.1 million attributable ounces of gold and about 420 million pounds of copper. So it does have some copper exposure, which I think is good as well. They're fairly diversified across 19 different countries, both in the Americas, Africa, the Middle East, Asia. So they're globally diversified. So in many ways, I like that. I have no problem owning Barrick as one of your ways to play gold if you're bullish on the miners as a whole. I think some of the bigger miners have been weighed down just because sentiment's been, they were the most owned, and I think they were the most sold during this downtrend. What are you seeing on Barrick, Luke?
Yeah, I have no problem with Barrick. I feel as though over the past month or so, we've gotten a call pretty frequently actually about this name. And the thing that I tend to point out is that when you want to invest in a commodity, sometimes you'd prefer to invest in the miner because they tend to be able to smooth out the investment returns relative to the incredibly volatile commodity, because mining companies can control costs during downturns when prices go down, right? That's something that doesn't really happen when you invest in it directly. But because Barrick is more diversified, it's going to be reacting not just to the cost of gold. It also, like you said, it's copper, silver. And when you see that very notable pop in gold, there can be a lag, a delay in what actually happens with Barrick, right? Because if something happens in a volatile way and it goes up and down pretty frequently, it doesn't necessarily mean that it's going to stay up, right? It could move down. So you're not going to see the market price in those instantaneous changes to gold so much as they will once they see what the revenue was like for that year and those sorts of aspects of the company business. So although it's underperforming, it could do better. I think it's a perfectly fine company, especially if you anticipate that the price of these commodities are going up.
Yeah, and the book value right now is only 1.17, near the low end of its longer term range. Long term, it trades closer to 2 times on average over the past couple decades. So I think there's a lot of room for upside here for Barrick. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point concerns the housing market over the next handful of years. And mortgage rates have come down a bit, but we're not seeing a huge change in underlying inventory, although you are seeing the sales of homes start to pick up. But it's not just about what has happened over the past couple of months, but really what's going to happen over the next 3 or 5 years. And will the market stabilize into something that's more realistic, that reflects the true supply and demand, underlying supply and demand in the market, right? We know there are factors that are keeping people off the sidelines, like high mortgage rates, and keeping people on the sidelines from selling their home because of, same thing, high mortgage rates. So we're going to talk about all the factors that are likely to impact the housing market over the next 3-4 years or so. We also have some voice bank questions in regards to the Vanguard Value ETF as well as Martin Transportation. We also are going to touch on the demand for gold and where that is coming from. Hint, hint, China is a big factor there. And then if we have time, asset prices more broadly are headed higher. But there can be risks and various risks and rewards across the globe. And should you think about moving some capital overseas as an investor? So we're going to look at that as well. But of course, your finance and investment questions are number one. 888-99-CHART is how you get through and ask your question on today's show. Now, Luke, let's discuss the market for today. It was broadly a negative day as we followed a pretty bullish week last week. Did you see anything that really caught your eye when it came to the trends in the market today?
Not really. It was pretty quiet from a news perspective. It was pretty range bound. It didn't really bump up. There wasn't much volatility. With the exception of the Russell 2000, which extended its gains from last week, which was good for small caps. Crude oil was up over 1.5%. The big news this morning, I remember texting you very early in the morning, was about Boeing parting ways with their CEO and some of upper-level management, something that we've said over and over again is something that needs to happen before you should consider investing in that company. Obviously, it's going to take a while to turn the ship. There's a lot going on. They're in some pretty choppy waters, but maybe with a new management team, certainly the old one couldn't do it, and hopefully with a new management team, they can right the ship there.
Still a lot of turbulence in that business.
A lot of turbulence. I was trying to go for a different transportation joke, make it seem like a less obvious pun. I was going with ships, you went with planes.
Yeah,
but no, I mean, other than that, I think the market's for the most part looking forward to PCE being the big news on Friday. But obviously with the market being closed, we won't see a reaction until Monday.
Yeah, we have durable goods that comes out tomorrow, so that should be interesting to see the underlying strength or weakness in the consumer. You have pending home sales. That's on Thursday. Obviously, initial jobless claims as well. So those are things that will be the market will be paying attention to. But like you said, the PCE is on Friday, but the market is closed. And Boeing, as we go back to that, it was up today, but not as much as I expected, right? It's only up a little over 1% on the day, faded really throughout the day. And maybe it's just the market saying, hey, I know you're stepping down, but you need to step down now, not at the end of the year. And that's just the CEO. And we know these large companies, oftentimes when there's rot from within, it's not just the head of the snake, right? It's rotten through the core. So I think there needs to be deeper management changes at Boeing beyond just the CEO. But what we shall see, we'll see how the market reacts. And today, I didn't think the market reacted as bullishly as I would expect. So, yeah, that was the market today. Slight down day in an overbought market. So not shocking as we head out through this week. Now, our focus point today concerns this topic: housing market prediction for 2024 to 2028. Now, we know mortgage rates have come down a bit, and more buyers and sellers are entering the market, but housing prices remain, let's just say the clearing price hasn't been found for most markets due to low volume of transactions. Now, over the next 5-7 years or so, the trends that we saw during the COVID-19 pandemic are likely to continue, right? Migration trends, mainly work from home, mainly. But other factors are gaining importance as well. Aging population is number one, and the rising costs of climate change. And so all of these factors mean the housing market will evolve. It always evolves over the next 3, 4, 5 years. But right now, the main driver of the underlying market has to do with people being rate locked. Nearly 90% of homeowners have mortgage rates under 6%. So until you get mortgage rates back to around that level, maybe a little bit lower, that will be what it takes to prompt a lot of the existing supply to be unlocked. Now, Luke, we are seeing a little bit of increase here, but is that, it's probably just eventually people give up and they have to sell, right? They can't just hold on to their house forever, their 3% mortgage forever at all costs. There's always a breaking point at some point, right?
Yeah, that's true. I think some people necessitate sales. And when somebody needs to sell their house, it opens in the market, it nearly immediately closes. I know from having some friends who are recently looking to buy homes how difficult it is. But in terms of dynamics, I think there's a lot going on. There's going to be likely in the next decade or so, right, an entire generation, the largest generation of homeowners in this country, baby boomers, who are going to be, say, delicately passing away. And a lot of their children have those homes that you're talking about that are mortgage locked and don't have a need to have a family home. This isn't the generation that's in waiting in terms of inheritance, isn't a generation that is going to likely keep the homes of their parents, right? So that's going to flood the market. It's going to drive down prices in the long term. I think in the next 5 years, from 23 to, from 2024 to 2028, and even into 2030, I think something that you and I have talked about, which is the likelihood of inflation being systematically higher than it has been in the past decade, is going to necessitate rates to not fall as far as some people hopes it will. That's certainly going to have an impact on the housing market. I think another thing that we didn't even know about until recently is going to be the settlement from this case with the National Realtors Association. How's that going to change the dynamic of buying and selling homes? We don't even know yet. I've seen some people say that it's going to be a good thing. Some people say that, well, take a step back. This was their idea. We don't know how deeply entrenched the realtors' fees are going to be within the new regime either. So there's a lot of competing interests. There's a lot of competing dynamics. So it's difficult to predict over the next 5 years what's going to happen. But certainly, I don't think that for some time prices are going to come down significantly.
Yeah, I don't think the realtor thing will have a strong impact longer term on housing costs, shall we say. Certainly, it could bring down the sales price because that buyer's side is likely now to be more often negotiated lower. So the seller doesn't have to pay, say, 5 or 6% of the purchase price. So their net, they can basically shave off, 1 or 2% of the purchase price, and they're getting the same as they were before, right? When they were paying 5 or 6, now they might be paying only 2.5, or 3% to their selling broker. So I think that could have a minor impact longer term as it adjusts. But overall, it's really going to be about incomes. I always say this, that what drives housing prices and real estate prices, it's incomes, because what pays a mortgage? What pays rent? It's income. So if incomes in a particular area are rising, then real estate prices in general over the long term are going to rise and vice versa. So population changes are going to be most impactful. And throughout last year, the nation gained 1.6 million people, but 90% of that annual increase was in the South, mainly Texas and Florida. The West had a little bit of growth, slight increase in the Midwest, but a decline in the Northeast. So those trends are likely to continue. And then hybrid work. We know by key card swipes and those types of data points, in the 10 largest cities, the amount of people going into office is about 50% from what it was pre-pandemic. And there's a lot of hybrid work environments, and so people can live a little farther. I think it's going to allow people a little more flexibility in where they live to search for cheaper alternatives. So I think you're going to see kind of structurally weaker demand for the more expensive areas, especially the 10 largest cities. They're losing tax revenue because a lot of people are moving out of there. So the life in a big city is not going to be as nice as it was unless they can fill that void. And demand in the Midwest, the South, areas where it's low cost of living, I think that will just continue. So, and then climate change, I think it's going to be more difficult to live in very, very hot regions of the country as well. And I think that will be a factor. So all of these are going to make a very interesting next few years for housing. On the next InvestTalk, we'll look into this question: who or what might benefit from the National Association of Realtors lawsuit settlement? Just as we kind of teased here on the last segment, we'll dig into that a little bit more. Will tech companies in the real estate space be winners? Will it be more feasible for people to start the home buying process without the aid of a real estate agent? So we'll talk about that tomorrow. But we're going to head over to San Diego, down to San Diego. I'm a little bit north of there. And talk to Will. He's looking at Anglo American, NGLOY. Do you own it or looking to buy it?
I'm looking to buy it. First of all, my thoughts go out to Steve and on his recovery.
Thank you
and
for
I
that.
thank you for taking my call. Yeah, I'm wondering if this is a good entry point for this stock.
Well, this is one of the largest miners in the world, $32 billion market cap. It's down pretty extensively from its all-time high, which was, let's see, about $28 per share. Am I zooming out far enough? Oh, no, its all-time high was back in 2007, around $36 per share. But it peaked out in 2022 around $28 per share. Now we're at $12.24. Supposed to make $1.14 this year or $1.20 next year. So you could say trading at about 10 times forward-looking earnings. But Luke, sales growth continues to ebb lower. I don't know. Do you think this is a good way to get exposure to the foreign markets?
Well, I think you nailed it.
I was thinking.
Sales growth has fallen. And that's because sales have actually gone down. Revenue's gone down. And because of that, their earnings before interest and taxes, their EBIT isn't enough really to cover their interest expenses, or rather, it isn't as much as it has been. It used to be around the 10 to 15 range. Now it's closer to 4. So they're pretty highly leveraged for a mining company whose revenue stream is going to be, like we talk about all the time, predicated upon the commodities that they're mining. So the volatility of that with the debt levels could be one of the reasons why this company has been on a persistent downtrend for a couple years.
Yeah, I think the issue is the type of minerals that it's exposed to. It is it's 1/3 of the world's platinum supply, and platinum prices have been headed lower and been in a strong downtrend. Just look at the PALL, which is the platinum ETF, and that is it peaked at about $280, and now it's at $62. So that's been in a downtrend, and it also owns 85% of De Beers, which is obviously the world's largest supplier and marketer of diamonds. And we know that the lab-grown diamonds are starting to encroach on the business of De Beers in a big way. So I just don't like it. Near term, I think it's okay. But I think if you're trying to gain exposure to commodities, I think you have many better options than this. I would pass.
Okay. I got you. Thanks a lot for taking my call.
No problem. Thanks for making it. That was De Beers, or no, that was De Beers. That was Anglo American, NGLOY.
They own De Beers.
There you go. They own De Beers. There we go. Now let's talk about the matchups for tomorrow's second round matchup in the old economy region. And the first matchup, Luke, is Southern Copper, SCCO, a name that we own for clients, one of, we think, the best copper miners out there, and then Sinclair Broadcasting. Tell the people about Sinclair.
Well, Sinclair Broadcasting, which which I previewed last week, owns a lot of local news stations, a lot of local stations. They actually owned one of the stations where my dad used to work. And so they were consolidating over the past 5-10 years, buying up a bunch of stations in different markets. There were some lawsuits in terms of the maximum amount they could hold. Anyway, big media company. And it was also up 7.2% today. So frankly, something's up 7.2%. I doubt that it'll be up significantly tomorrow. It'll probably pull back, especially for a company that has had some pretty weak relative strength since 2020. So because of that, I'm going to have to go with Southern Copper.
Southern Copper was down today, but almost 0.5%. It's pretty overbought, right? It's ran from the high 70s earlier in March, and now we're at 103 and change, almost 104. Closed today. I'm going to go with the one that's a little still oversold. I know it was up today, but I think Southern Copper looks a little overbought near term. So I'll go with Sinclair. Now let's look at the next matchup. That would be Century Aluminum, CENX, and that is going up against Permian Resources. And CENX is a very small cap, $1.2 billion market cap. It is a aluminum miner and smelter. And it was up pretty nicely today, up 66 cents on a $13 stock, so about 5% on the day. Definitely overbought going into tomorrow. What about Permian?
Yeah, Permian is a mid-cap oil and natural gas exploration company, and it was actually up about 82 basis points today, almost 1%, as was oil. Oil was up a 1.5%, I said, at the top of the show. So I think oil continues its march tomorrow. I would go with Permian Resources.
I agree. I think the momentum there is a little bit better and not quite as overbought. The next one is Ovintiv. This is a natural gas producer, and it's in a pretty strong uptrend here. Natural gas is starting to gain some traction on lower rig counts for oil. I don't know if you know this, if you guys know this, but when companies go drill for oil, their byproduct is typically oil, or is typically natural gas, and that's why natural gas is very cheap. And actually, the supply goes up when drilling goes up for oil. So you're starting to see the rig count go down, so that's why I think natural gas is getting a bid. What about Core and Main? This one's been a beast as of late, but was down $1.03 today. Tell them about Core and Main.
Yeah, Core and Main, it's a wastewater, fire protection products, storm drainage company. Real boring business. Not one of those big AI names, but a great one.
Nope.
And so over the past year, it's been, like you said, on a tear. It's up 171% from a year ago, 171%. And so pulled back about 177 today. I don't know if I can bet against Core and Main. I took Core and Main in the first round. I think I got to take it in the second round too.
I'm going to go with Ovintiv. I think the momentum's strong, and Core and Main is very overbought and down today, so I think it looks like it might be set for a bit of a pullback. The next one, the final matchup is Lennox International versus Eaton Corp. LII is Lennox, and they make climate control products, and about $17 billion market cap, relative strength 92. And if you look at the chart here, you certainly are getting not really a super overbought situation. So it just kind of continues to grind higher, although today it was down about 1%. What about Eaton?
Eaton, it's an industrial company. It's had a pretty decent run-up over the past year. Its relative strength is pretty high, and it's really just been powering through. It was down 1.5% today, but I think given its strength, its momentum, I would go with Eaton on this matchup.
So yeah, I'm going Eaton ETN. I think same thing like Core and Main. It's so overbought and down the day. I think it needs a little bit of breather. So I'm going to go with Lennox. All right, those are the matchups for tomorrow's second round in the old economy region. And we'll get to the winners tomorrow and preview the matchup for the consumer region, which will be on Wednesday. All right. Now let's touch a bit, Luke, on gold. We know gold has been on a tear as of late, and a lot of this has to do with demand from the East, not the West. And part of it is the confiscation of Russian Western assets, right? Treasuries, et cetera, due to the Ukraine war. And so countries are starting to think about maybe diversifying, not keeping their assets in treasuries, in dollars, because they don't want that potentially to be confiscated. What they can't confiscate, what the U.S. cannot confiscate, is actually gold. And so what's happening in China is that their central bank are buying records amounts of gold. And so, it's pretty interesting is that this isn't just a consumer habit in China, but it's also something that's happened from a government level as well.
Yeah, I think that's one of the reasons why Bitcoin has been successful too over the past year, is because governments are trying to diversify away the threat of having their assets seized by the U.S. or being cut off from SWIFT or any number of things. Gold has historically been a safe haven asset, but I don't think we should diminish specifically not just the Chinese government's demand, but also Chinese citizens' demand. If you think about what's been going on within the Chinese economy over the past year, you've had a, for lack of a better word, real estate crisis part of the property market crisis that has dragged down the entire economy. And so you don't have demand looking like it's going to be as robust as once thought over the next couple of years. You have that real estate crisis, and you have a potentially destabilized government because of it in the long term. And so people are more fearful in China than they have been for quite some time. So the Chinese consumer demand is just as strong as the Chinese government demand, but for different reasons.
Yeah, sales of gold and silver jewelry in China rose 24% year over year during the most recent Lunar New Year period, which is the time when a lot of Chinese go shopping. And the People's Bank of China bought more gold than any global central bank last year. They bought about 225 metric tons. It was their biggest expansion of gold reserves since 1977. And they have their pension funds, insurers, other state-linked investors are also buying up gold as well. And China imported 367 metric tons of precious metal, of gold, during the first 2 months of this year, a 51% increase year over year. And then on top of that, you have a lot of investors, mom and pop investors, that they used to buy company stock, right, in Chinese companies like Alibaba, et cetera. But most of those names are down dramatically as well. So, they're looking for alternative places to put their money. And all of these line up for a situation where gold prices are likely to continue to head higher. All it really needs, I think, is a weak dollar. And you may see that later in the year once the Fed starts their easing process. Now, this is InvestTalk, and our 24/7 voice bank never closes. Here comes another listener question from 888-99-CHART.
Good afternoon, gentlemen. This is Mark calling from Santa Cruz. First of all, thank you for the daily edition of InvestTalk. I've been totally hooked for years. I am a retiree for several years now, and as an investor, I would classify myself as a dividend/income value investor. I have a question. If you could explain, please, a little bit about what covered call ETFs are, how they work. Are they cyclical? Would you recommend them for retirees to help out with additional income? Again, thank you guys very much for all that you do, and I'm looking forward to your answer. Thank you.
Now, we're very familiar with a covered call type strategy. We run that at KPP Financial. It's called Equity Income Plus. It's a very popular strategy for many of our clients who want equity exposure, but not as much risk as just owning equities outright. And what it typically does is, what we do at least, we we sell call options on a monthly basis. We roll them every month. We bring in premiums into the portfolio. And what that does is, any downside that you see in markets, you don't feel the full brunt of it because those option premiums you keep no matter what, and then they typically expire worthless. So you buy them back for a very small amount. And so that is that's what running a cover call strategy does for an all equity portfolio. Now, for a lot of these cover call ETFs, it's really more about the underlying. Now, we run a cover call strategy, so we like a cover call strategy for those that want to be maybe more moderately aggressive as opposed to fully aggressive in the markets. But I always say it's not just about the cover call. It's about owning the underlying. Because how a cover call works is simply, if you own a stock, I'll use an example, it's a $50 stock. You might sell a 50 strike call, and you might get, let's say, 50 cents or $1 for that call. It's called $1 for round numbers. So your effective purchase price is $49 and your upside is $55, but your downside is still substantial. So if you buy a stock, and we've seen many that go down 60, 70, 80%, then it doesn't matter how many calls you sell, you're going to hedge a little bit on the downside, but there still can be major downside if you pick the wrong equity. So that's why it's important to understand the underlying and not just buy into, it's a cover call ETF or it's a cover call strategy and I want to own it. Anything to add, Luke?
Well, doesn't it differ from a traditional covered call strategy because a lot of the times they're using index futures?
Yeah,
index future settlement,
that's
right?
true. Some of them are just simply
on the underlying. It's going to be settled in cash instead of actually having to give the security.
Yeah, so a lot of them are simply following an index, right? If it's an S&P, there's S&P ones, NASDAQ ones, maybe even Dow cover call ETFs. And then there are more active ones. I know JP Morgan has one that buys on individual stocks and sells calls there. So yeah, you're right, Luke. There are different ways to kind of execute that. So I don't necessarily they're bad. It's just knowing what you're buying, and it's not just about the covered call nature.
Hey Justin, this is Frank from LA. I've been listening to the show lately, and I've heard you say multiple times that you prefer shorter duration Treasury bonds as opposed to longer. Can you explain to me why it is more advisable in this environment to get a position in, say, a 5-year duration bond as opposed to, say, 10 to 15 years? And assuming starting from June, interest rates are going to be cut, why do you believe shorter duration bonds are still a better play? Thank you very much for all you guys do, and I'll be listening on the show.
Well, that's pretty simple. That long term, if inflation remains relatively elevated, if our government debt continues to head higher, the cost of our debt is likely to head higher as well. And if interest rates continue to rise, then the value of those long duration bonds will continue to go down. And you can see that I pull up the IEF, which is the 10-year Treasury bond ETF. That peaked out in 2020 at around $122 per share. It bottomed earlier last year, summer of last year, at around $90. Now we're at $94. And so, yes, it's rallied. Could rates drop a little bit in the near term if you get into a deep rate cutting cycle? Sure. But just look what's happening now. Inflation got to 3, and you're starting to see 2 months of an uptick. And it's going to be a lot harder to get that inflation from 3 all the way down to 2, which means that even if the Fed does embark on a rate cutting cycle, it's not going to be very aggressive because they're going to risk sparking, inflation higher again, which, likely will happen over the next year or two. And so, yes, could long duration bonds be good in the maybe a 3, 6, 9 month time frame? Potentially. But over, I think, a 3 to 5 year time frame, rates are headed higher, and you're going to want shorter duration in that environment, as we saw over the past couple of years. Anything to add, Luke?
No, pretty much covers it.
Well, lastly, Luke, let's talk a bit about foreign stocks. And we know that asset prices are working well right now, but we also know that our domestic stock market is heavily weighted towards the growthier names, the big tech names that everyone's excited about, the potential for AI and the domination of software more broadly in our economy. But value stocks are deeply unfashionable, not just here, but abroad as well. So the question, Luke, is should investors be thinking about the value side of the market, both domestically and abroad?
Well, I think let's take that in 2 parts. I think investors should always be thinking about the value side of the market, right? Because those are the things that you're paying less for more. You're paying a lower price for more assets, a lower price for more cash flow, a lower price for more sales. And you should always be thinking about the international side of the market, because I think generally investors tend to have a home bias, right? And so much as you don't want to put all your eggs in one basket in terms of keeping your company stock options that also pay you salary, it's also good to diversify away from country-specific risk. And we've been at a time where the United States has had an economy that's powering through, inflation coming down, especially relative to other nations. And so with that in mind and how markets have priced that in, there are some pretty attractive valuations internationally that I think people should consider branching out beyond the U.S. market because 10, 15 years from now, you could get a lot better returns from holding on to more heavily weighted, or rather weighting your portfolio more towards international than you have historically. And I'll go crazy and overboard, but still, I think a lot of people too often have that home bias that keeps them in the U.S. market when they should also be looking beyond that.
Yeah, and if the world's going to continue to change of not necessarily reshoring manufacturing, but friendshoring, there's a lot of opportunity in countries that have good demographics. Think Mexico, think India, that are also allies of the United States, and where companies are more comfortable putting their capital in building out their manufacturing capabilities. And so I do think that there are much more opportunities right now with the world changing so much than there have been in the past. And so I think of in many ways this is like China in many parts of the world in the late 90s, where things are moving, things are changing, and there's a long runway for positive trends in many countries throughout the world. All right, well, that does it. I'm Justin Klein with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. Independent thinking showed success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.